A concentrated stock position feels great when it's going up and very uncomfortable when you realize how much of your life is tied to it. When people hear the phrase concentrated stock position, it usually means one thing: success. Maybe you built wealth through company stock. Maybe you received equity compensation over time. Maybe you inherited a position, or maybe one investment simply performed so well that it became a much larger part of your portfolio than you ever intended. And on the surface, that sounds like a good problem. But concentrated stock creates a real planning challenge. Because while one investment can help build wealth, it can also create a situation where too much of your financial future is tied to one company, one management team, and one outcome. Built through concentration, sustained through planning. So in this video, I want to walk through how to think about concentrated stock, the risk that comes with it, and the planning approaches investors may want to consider. Not shortcuts, not gimmicks, just a dynamic framework. So, what is a concentrated stock position? A concentrated stock position is when a large portion of your portfolio, or even your overall net worth, is tied to a single stock or company. That can happen through employer stock or equity compensation, long-term ownership of a high-performing investment, business transactions, or even an inheritance. The issue is not necessarily the quality of the company. The issue is how much of your financial life depends on it. Good investment does not equal appropriate concentration, because even great companies can experience volatility. And when one position becomes too large, it introduces a different kind of risk. So let's talk about the three core risks. There are three major risks that come with concentrated stock positions. Number one, market risk. Think about it. If one position represents a significant portion of your wealth, any decline in that stock can have an outsized impact on your overall financial plan. Number two is tax risks. Many concentrated positions come with a substantial unrealized gains. That creates hesitation because selling may result in capital gains taxes, which can make investors delay decisions even when diversification might make sense. Third is behavioral risk. This is often the biggest one. Investors can become emotionally attached to a stock. They think, I know this company. It's done well for me. I'll wait until it gets back up to where it was. That's human. But familiarity and past performance don't eliminate future risk. Market risk, tax risk, behavior risk. The goal is not to react emotionally. The goal is to make sure one position doesn't quietly become the entire plan. So what should we do? One approach investors may consider is a staged diversification strategy. Instead of making a single large decision, this approach involves gradually reducing exposure over time. This type of framework may allow investors to take a more measured approach, reduce emotional decision-making, and spread activity across time periods, while also aligning decisions with broader financial planning considerations. Phase 1, evaluate. Phase 2, gradually reduce. Phase 3 is reallocation, and Phase 4 is ongoing review. Now, to be clear, this is not a recommendation for every investor. It's simply a planning approach that may be appropriate in certain situations. And sometimes the most effective strategies are the least complicated. Not flashy, just disciplined. Okay, so what do we do now once we've sold some of that stock? Here's where people often get it wrong. They focus entirely on how to reduce the stock, but the more important question is, what is the capital being repositioned into? Because diversification is not just about selling something, it's about building something more efficient in its place. That might include broader exposure across sectors, different asset classes, maybe income-producing investments, or a more structured long-term allocation strategy. Selling is one step, rebuilding is the strategy. Without a clear reinvestment plan, reducing concentration doesn't necessarily improve your outcomes. It just changes the risk. Another approach that may come up in these conversations is direct indexing. At a high level, direct indexing involves owning individual securities designed to track an index, rather than investing through a traditional mutual fund or pooled vehicle. This may offer broader market exposure. It can also offer customization, maybe the ability to manage overlap with existing holdings, and potential tax management features. But this is where it's important to be balanced, because while there are potential benefits, there are also important considerations. Here's some potential benefits. Customization of holdings, flexibility in portfolio construction, tax management opportunities in certain environments. Some of the considerations and risks you need to evaluate involve higher fees, investment minimums, performance may not perfectly track a benchmark, and it also involves tax complexity, including wash sale considerations. Tax loss harvesting opportunities may diminish over time, and like all investing, it involves risk, including loss of principal. When we look at the benefits versus the considerations, direct indexing is not a one-size-fits-all solution. It's simply one approach that may be evaluated as part of a broader planning strategy. Now, for investors who are charitably inclined, another planning concept to evaluate is gifting appreciated stock. Instead of selling shares and donating cash, some investors may consider donating shares directly. Now, this approach may reduce concentrated exposure, support charitable goals, and create potential tax efficiencies depending on individual circumstances. This is where investment planning connects with tax planning, estate planning, and legacy goals. Now remember, planning is connected, not isolated. And that's where more thoughtful strategies tend to emerge. So what are some questions to ask before making a decision? Before making any changes, here are a few important questions to consider. How large is this position relative to everything else? Number 2, what impact would a significant decline have? Number 3, what are the potential tax implications? 4, is there a defined diversification strategy? 5, what role should this position play going forward? Because sometimes the biggest risk isn't the stock itself, it's the lack of a plan around it. Now, this is not about telling everyone to sell their stock. It's about making sure your portfolio is aligned with your goals. Because concentrated positions don't become risky overnight. They become risky when they quietly grow into something too large to ignore. And the sooner you shift from, I should probably do something, to, I have a clearer plan, the better your decision making becomes. Here's the bottom line, folks. A concentrated stock position is not automatically a problem, but it can become one when a single investment has too much influence over your financial future. The good news is there are usually more than 2 options. It's rarely just sell everything or do nothing. There is often a thoughtful middle ground, a structured approach, a diversified strategy, a more intentional plan, because one stock may help you build wealth, but financial independence usually comes from how that wealth is managed over time. One stock can build wealth, a plan helps sustain it. If you're sitting on a concentrated position and not sure what to do next, it may be time for a planning conversation.